Hello, I'm Bode Oshosami, and this is Global Business Insights, where we go deeper on some of the main business headlines across the globe. Global markets continue to digest the second quarter releases of major technology stocks, watching for rotation away from growth stocks and some selling off to milk profits. Also, central banks' divergence continues to play out as the Bank of England yesterday delivered a hawkish interest rate cut to 5% in the first drop since March 2020. Chevron today announced a 26% decline in net income to $4.43 billion or $2.43 per share, less than $2.93 per share expected. This was due to pressure from lower refining margins and natural gas prices. Chevron is also moving its headquarters from California to Texas amid a standoff between the state and its business community over red tape. Exxon also posted earnings of $2.14 a share, better than expectations of $2.02 and better than $1.94 a share a year ago. The main story of today is the release of United States non-farm payrolls just came out. Non-farm payrolls in the US was up 114,000 jobs added in July, much less than 175,000 expected. Ahead of today's data, there was already concern that the economy may be cooling too quickly, with inflation not exactly conquered. Yesterday, we had initial unemployment claims at 249,000, also the highest weekly initial jobless claims figure in nearly a year. Still, U.S. economic growth in the first half of the year was solid. The economy expanded a robust 2.8% in Q2. However, more recent data like yesterday's U.S. Institute for Supply Management Manufacturing Purchasing Managers Index for July came out in contraction, down to an 8-month low of 46.8. On tech stocks reporting this week, Apple yesterday reported June quarter results beating Wall Street revenue expectations, with overall revenue rising 5%. Sales of the iPhone were, however, lower, 0.9% than in the year earlier. But it still got to $39.3 billion this quarter, better than $38.8 billion expected. That's iPhone's revenue. Amazon, according to its release yesterday, said net sales increased 10% to $148 billion in the second quarter, compared with $134.4 billion in Q2 2023. We will discuss Amazon's results later in more detail. We also saw Intel shares plunging after the chipmaker delivered some bad news, including a Q2 miss, a dividend suspension, a weak outlook, and plans to slash 15% of its workforce. Overall, big tech earnings for the quarter ending in June have been a mixed bag. Alphabet, Apple, and Microsoft all fell after they reported, while a solid beat for Meta on Wednesday sent their own stock up nearly 5%. We will also replay in this episode the latest on the Nigerian economy, with July PMIs that came out yesterday and new legislation raising the cap on ways and means borrowing. Non-farm payrolls in the US was up 114,000 in July after a revised 179,000 increase in June, and very short of the market expectation of 175,000. The labor participation rate ticked up to 62.7% from 62.6%, while annual wage inflation declined to 3.6% from 3.8%. The unemployment rate also inched up to 4.3% from 4.1%, while wage growth month on month also dropped from 0.3% to 0.2%. The weaker US non-farm payrolls data just out may indeed confirm rate cut expectations. That's in September, but it also exacerbates fears of a downturn in the economy. Lower wage growth data is also good news for the US Fed war on inflation, and unemployment inching up will encourage easing to help the labor market, coupled with other data such as the PMI showing a cooling economy. US stock futures fell as the data came out. Also, the 2-year Treasury yield, which moves with interest rate expectations, fell 0.26 percentage points to 3.9% after the release. The July data that just came out points to yet another signal of a cooling labor market after a long post-pandemic spell of unusual vigor, and the Fed will consider this as well as, like I said, other data trends in cutting rates at the next September meeting, which is looking increasingly likely, barring upside surprises from CPI or personal consumption expenditure reads. All this as investors worry that the Fed may have waited a bit too long to cut interest rates. Amazon's revenue yesterday came in slightly less than Wall Street's expectations, even as CEO Andy Jassy talked up AI investments and solid cloud business growth. It was a tale of slowing online sales growth as consumers also sought out cheaper options. Analysts expected sales of 148.7 billion, but June quarter sales came in at 148 billion, still up 10% from the same period last year. Earnings of $1.26 spiked up 94% from last year, ahead of estimates of $1.03 a share. Highest revenue growth was from advertising services at 20% year-on-year for $12.8 billion in revenue, but still disappointing analyst expectations. Meanwhile, Amazon Web Services cloud unit raked in $26.3 billion in the quarter. That's a 19% increase and above the $26 billion estimate. That's still below the 21% growth from rival Microsoft's cloud business. Amazon Web Services, like rivals, continue to see strong growth as they embed artificial intelligence capabilities. On guidance for the next quarter, it was somewhat weaker. Amazon said revenue would come in at 154 to 158.5 billion in the next quarter, lower than about 158.2 billion average estimated by analysts. Capital spending is also soaring, as CEO Jassy reiterated. Amazon was investing a lot in AI and expects to spend even more in the second half of 2024. What are we learning so far from Q2 results? First, we are seeing tech growth narrative beginning to show some cracks. In my view, there are still those signs of a hard landing as we speak. Amazon shares struggling. It's been a very difficult day for markets. Amazon is down 10.7%. According to the released July data, the Nigerian private sector slipped into contraction territory in June as steep price pressures hit demand and resulted in reductions in both business activity and new orders. Rising costs and selling prices continue to rise rapidly as confidence hit a new record low. Stanbic IBTC headline PMI declined for the second consecutive month to 49.2 points in July, also the lowest level since November 2023. Good news from the data is the resilience in job creation, as the report says rate of job creation picked up to the strongest in 2024 so far. Also, though prices continue to go up, the pace of inflation eased from that seen in June and was actually the slowest pace since May 2023. The PMI report says on a year-on-year basis, headline inflation may have peaked in June, with moderation expected to be seen in the second half of the year. The report's basis for this peaking scenario is that the year-on-year effects of PMS subsidy removal, which induced higher fuel prices and significant currency depreciation, which accompanied the FX unification, will have been fading. Also, the commencement of the primary harvest season in September will help food supply and depress prices. We also expect to see the impact of expanded food importation and removal of associated levies on imports. But analysts tend to differ, saying that it's Nigeria's exchange rate devaluation that is inflationary, not as much this removal of subsidy. As such, July inflation will more likely be worse than June, given steady weekly devaluation throughout July that must already have passed through to July CPI. To tame inflation, you must tame the exchange rate. Also, the government needs to stimulate the economy. Infrastructure projects, homes construction, higher minimum wage, all will inject spending appetite and maybe new vigor in the economy. Analysts observe that the PMI metric is difficult to interpret, also without clarity on what is happening to inventory. Yesterday, on the 31st of July, both chambers of the National Assembly raised the threshold for the ways and means advances by the Central Bank of Nigeria to the federal government from 5% to 10% of the previous year's revenue. This was supposedly to plug seasonal or temporary shortfalls, limiting ability to execute the year's budget. Although this does not justify past breaching of the low limit to the tune of 50% to over 300%, some have said the increase of ways and means to 10% is realistic, it's not excessive, and more tolerable than the previous experience under the President Muhammadu Buhari administration. While ways and means are typically used to plug spending gaps caused by seasonality issues, especially with revenue, it can be abused as a permanent tool to finance deficits, especially as revenues drop, and which of course will have an inflationary effect. I see some issues, noting that when you compare government spend per capita with other peer economies, Nigeria's spend is inadequate. Revenue to the GDP ratio is also very low. The size of the budget is limited given the population size and needs. And to make matters worse, recent revenues have also underperformed expectations. What matters even more, therefore, is not the quantum spent, but how judicious and disciplined expenditures are. First, there is need for transparency and discipline to adhere to the new limit. There should be strict guidelines with strong consequences for exceeding. The government should promptly tell Nigerians how revenues, spending, and deficits have fared in the first half of 2024 to start with, and what exactly these amounts were spent on for better clarity, transparency, and context. There's also a clarion call to reimagine size and scale of governance, making dramatic changes, especially in recurrent expenditures. Also, to raise cheaper funds, there is need to accelerate privatization and raising equity or sale of government assets to reduce the deficit or to find funds to invest in productive projects like technology infrastructure, education, welfare, and support for small and medium enterprises. The government needs to also stimulate growth of the economy with targeted support incentives to boost high growth potential sectors. The government also needs to set up an independent fiscal watchdog to monitor fiscal discipline and provide quarterly independent assessments to the public on how monies are being spent. But on a day where Nigerians are groaning under high interest rates and record high inflation, many on the streets are also protesting. This will be received as yet another prelude to more profligacy. For a government that has passed 3 supplementary appropriation bills since coming to power 15 months back, raising ways and means suggests that claims that reforms have positively impacted revenues may not be true. For a regime that has recorded so much higher headline and food inflation for its 15 consecutive months in office, what solace is a doubling of money printing limit expected to offer a populace that are about to hit the streets to protest against high cost of living resulting from the inflation. This administration's central bank monetary policy has also hiked the monetary policy by as much as 450 basis points, with interest rates now at a prohibitive 26.75%. How much damage will the loosening of the ways and means limit do to their efforts to tame prices? Will the government and central bank be disciplined to keep to the limits? We have to wait and see. Brent crude is still headed for a 4th weekly decline as demand concerns in the world's 2 biggest economies overshadowed the heightened geopolitical risk. Brent is back to under $80 per barrel. Asian stocks fell as sentiment was hurt by a sell-off in Japanese equities, the global tech rout, and some signs of weakness in the US economy. European stocks also down amid what looked like a global downturn, concerns over tech earnings and US economic data sparking fears of a recession. And in the US, it looks like the Nasdaq slipped into correction territory as sell-off of tech stocks got worse, especially after the non-farm payrolls data. That's it from me on Global Business Insights. This is Bodi Oshosani. Thanks for sharing and following or subscribing on Facebook, LinkedIn, or YouTube and X. Please send your comments. Do enjoy your weekend. Bye-bye.